Hello and good afternoon, everyone. I'd like to welcome everyone onto this event today around the key tax actions and succession planning options to be considering ahead of the end of the tax year, so the 5th of April 2025. If anyone has any technical issues, feel free to contact us using the chat function, and there will be a Q&A session towards the end of the event. So if you have any questions, feel free to put these in the Q&A box and we'll address these at the end. Now, it's fair to say that the tax landscape has changed quite significantly compared to 12 months ago, with the new Labour government and the announcements made in the budget on the 30th of October. So with this in mind, and in the lead up to the end of the current tax year, the 5th of April, we want to explore some of the most important tax actions that business owners need to be considering before the 5th of April deadline. And we'll look at some succession planning options too, including some examples of how this has benefited a number of our clients. Also on the panel this afternoon, we've got Gerry Surtees, a tax partner here at Oldfield Advisory. So what's going to change on the 5th of April then, Gerry?
Thanks, Jack. So, as is often the case, the budget was a mix of immediate tax changes on the day of the budget, tax changes that take effect from the new tax year, and also some future announcements as well, which will be the subject of future announcements, future legislation. Just before I get into that, thought it might be helpful just to set out briefly what we're going to talk about today. Which is firstly just looking at an overview of the budget changes, in particular those that will be taking place from the start of the new tax year. Then Jack will talk to us about what actions we need to be taking in the light of that. Section on capital accumulation and succession planning and the relevance of that in context of the end of the tax year. And then some key takeaways and a Q&A at the end where we'll look to try and address your questions that you've posted as we go along. So just to cover off on the key changes, as I say, focusing today mainly on the changes that are going to be taking effect from the start of the new tax year, from the 6th of April. Employers' national insurance contributions, essentially there's three changes that have happened on that. Firstly, the headline rate is changing from 13.8 to 15%. The secondary threshold, that's the level of salary at which companies start paying employers' national insurance, is reducing from £9,100 to £5,000 per employee. And also the employment allowance is increasing from 5,000 to 10,500 with effect from the new tax year and becomes available to all businesses regardless of size. So they're the overall changes on that. As far as stamp duty land tax is concerned, the threshold will be with effect from the end of March. The starting threshold, where you start paying stamp duty, will drop from 250 to 125,000 with a starting rate of 2%. So that's effectively reverting back to the rates as they were earlier, which essentially means an extra £2,500 of stamp duty for anyone paying over £250,000 for a residential property. Also, for first-time buyers, the thresholds are reducing from the current bands of 425, which is 0%, and up to 625, which is 5%, to 300 and 500 respectively. So from that point, anyone paying more than £500,000 for a first-time house won't be able to benefit from that relief. And for completeness for Scottish and Welsh residents, there will be no changes. The devolved governments have said there will be no changes to rates and bands from the new tax year. There has, however, been some increases in the supplement for second homes in both devolved regions, in line with what's happened in the UK in the last few weeks. Double cab pickups. This is an area that hasn't got a lot of attention with everything else that's been going on, but nonetheless, a bit of a contentious move. The government have decided to impose recent developments in case law in respect of double cab pickups, which broadly means that any new double cab pickups from the 6th of April for benefit in kind purposes and from the 1st of April for capital allowance purposes will be treated as cars rather than commercial vehicles. So that's just an important date to be aware of. 1st of April applies for companies for capital allowances purposes. There are some transitional arrangements in place which essentially allow that if you purchase, lease, or order a double cab pickup essentially by the 31st of March, then it'll continue to be treated as a commercial vehicle, which effectively applies the old rules until the earlier of disposal, the expiry of the lease, or the 5th of April 2029. So important one to be aware of. Finally, what used to be called entrepreneurs relief, now called business asset disposal relief, is still in place, wasn't scrapped in the budget, and in fact, up until the end of the tax year, remains at the old rate of 10% on up to £1 million lifetime allowance. So that will, on the 6th of April, that will increase to 14%, and again from 6th of April next year, 2026, to 18%. So that means that with a lifetime allowance of £1 million, an individual could save up to £40,000 of capital gains tax on any qualifying disposals that they make on or before the 5th of April. Well, what else was there that was announced in the budget that might be relevant? Well, the big announcements, as I think most are aware, were inheritance tax related, limiting business and agricultural reliefs to 50% above the what will be an individual allowance of £1 million, and also imposing full rates of inheritance tax on pension funds. These measures, in theory, don't come into place until April 26 and April 27, respectively, for pension funds. However, they already apply for gifts which are made now for anyone that dies on or after the 6th of April 2026. So it's important to be aware of them. Also, I think it's relevant in the context of some of the other tax changes that we're going to touch on later in this event. So I'll hand you back to Jack to talk about some key points to think about before the end of the tax year.
Thanks, Gerry. So with these imminent changes in mind, I just want to really go into this further in terms of what actions it should be prompting from business owners. And Gerry's already mentioned about double cab pickups very briefly. What that effectively means is that the vast majority, if not all, double cab pickups will be taxed as cars from 6th of April 2025. And I'm particularly focusing here on benefit in kind purposes. And just to demonstrate the impact of this, I thought it'd be clearest to just run through a real life example. So in this example, we've got looking at an employee who is currently in the 40% tax bracket. Now, this does obviously apply to both direct and employees, but just looking at employee for now. And they're provided with a double cab Ford Ranger, so a reasonably, I say, standard double cab pickup. Now, on the assumption they receive fuel benefit as well, for the 2025-26 tax year, if you owned the vehicle pre-5th of April, the employee will be taxed at commercial vehicle rates. So they pay £159 per month in tax for the vehicle. But if exactly the same employee had exactly the same vehicle, but the vehicle had been bought after the 5th of April, they'd pay £853 in benefit in kind tax per month. So that's an extra nearly £700 per month in tax. So, and to compound this further, these calculations don't take into account whether that additional benefit in kind could and might actually push an employee's income above £100,000. So at that point, they begin to lose their personal allowance as well. They'll be paying an effective tax rate of about 60%. So as you can see, the impact of this is quite significant and especially when you're talking about looking at employees. And in relation to the capital allowances element, so for companies to be able to claim 100% of the cost of the vehicle against their taxable profits in the year of purchase, the important date is that the vehicle needs to have been ordered by the 31st of March 2025. So really the key action is to make sure you've ordered any double cab pickups by 31st of March. And as a side, just mention while researching for this, I was having a look at some of the vehicles out there and did notice that at least one manufacturer has now announced they are looking to launch a plug-in hybrid double cab pickup. So that should be, and we'll wait and see the actual figures, but should be a lot more tax efficient option for those that actually require a double cab pickup for work purposes. So that'll be an interesting one to watch out for. And while we're on the subject of vehicles, another important area to cover is in relation to plug-in hybrid cars. Now, whilst the benefit in kind tax rates for those aren't significantly changing at 6th of April 2025, they do change from 6th of April 2028. And I think it's just important that you're aware of this impact for directors and employees, and you're the planning for it now, because a fairly typical approach that we see in many businesses is to take out 3-year contracts for vehicles. So these changes will impact plug-in hybrid vehicles that you're receiving from April 2025 onwards, i.e., if you order a vehicle now, receive it in May 2025, for the last couple of months of that lease, the employee that has that vehicle will pay the higher rates of benefit in kind. So again, just turning to an example to demonstrate this, just show the impact of this. And again, we're looking at a 40% taxpayer again. So in this example, we've got VW Passat plug-in hybrid. It's got a list price of 48,000, just under 50,000. And due to quite a high electric-only range, it currently qualifies in the current tax year for 5% benefit in kind. But in the new tax year, it'll be 6%. So in next year, an employee will be paying £97 tax per month for that vehicle. And this, over the next couple of years, rises reasonably moderately. But then if you've got that 3-year contract, as soon as they get past April 2028, the benefit in kind jumps up to £292 per month. So if nothing else, you need to make sure that both yourself and your employees are aware of this impact. When you're looking at replacement vehicles over the coming years, it might not change your decision, but you need to be aware of it. You may look to even take on shorter contracts. So i.e., for a plug-in hybrid vehicle, you might want to do a 2-year contract so you don't go past that point. But in the least, you just need to make sure that those with the vehicle, whether it be directors or employees, are aware and know about the tax. A couple of other actions to consider before tax year end include, if you have any significant bonuses to be paid to staff at the end of, say, April, there would be a tax saving for the company to pay these in March instead to avoid the increase in employers' national insurance rates. The impact of this is only small in reality, though. So 1.2% of the total amount of bonuses paid. So you've also got to balance that with cash, and in reality, the tax saving is pretty small. You could also look to pay pension contributions to employees instead of bonuses, and this has suddenly become a lot more attractive to employers. Obviously, this only works for a fairly niche group of employees, so those that don't require their bonuses as cash in hand now, but are happy for these to be made as additional pension contributions. And the reason is that there is no employer's national insurance payable on pension contributions. So effectively, you're saving the company 15% of the value of the contribution. This is also a win-win for both employer and employee, as the employees will ultimately get 25% tax-free when withdrawing from the pension, and there is a small employee national insurance saving as well. On the subject of pension contributions, they are also an effective way of extracting funds for directors where applicable, as you get a corporation tax deduction and there's no employer's national insurance to pay. You will obviously just need to be aware of the inheritance tax implications that Gerry's mentioned earlier in relation to pension funds. Another aspect to consider, Gerry's already briefly touched on it, is just making sure that you've registered for the employment allowance. So for businesses that haven't previously qualified for employment allowance, you will now be able to claim it from April 2025, but you will need to register for this. It's not automatic. So if you're not sure, check with your accountant to make sure you are registered for the employment allowance and you are taking advantage of that. Also ahead of the 31st of March, if you're currently in the process of a purchase of a residential house, make sure you have them before 31st of March just to save you that stamp duty land tax, especially first-time buyers. Um, and finally, as we fairly typically mention in the run up to the 5th of April, just make sure that every shareholder and potentially even wider family members are using their basic rate tax allowances for dividends. Because if you don't declare dividends before 5th of April, you've lost the opportunity to use those low rates of tax. Now, I know there's a broad mix of attendees on this call, both ongoing clients of Oldfield and some who are not ongoing clients. For those that are ongoing clients of Oldfield and we look after your dividend planning, if we haven't already been in touch, we will be in touch over the coming weeks to discuss your remuneration planning for the current tax year, making sure you're using those allowances. If you're not an ongoing client, you need to check with your accountant that they are properly considering and ensuring that the relevant tax bands are being fully utilised. It's one of those areas that we do see a number of accountants missing out on, making sure you're making use of those really low tax rates. Gerry, over to you on succession planning.
Thanks, Jack. So, as mentioned earlier, the rate of capital gains tax for business asset disposal relief qualifying disposals, so what used to be known as entrepreneurs relief, that's going up from 10% to 14% on the 6th of April, which does mean that we've got a very short window of time to take advantage of this. We've only got another couple of months before the end of the tax year. So if it's something that you are going to take advantage of, it's important to do that, to look at doing that sooner rather than later. And I think just in thinking that through, one of the areas which we feel is particularly increasingly relevant is for senior shareholders to look at their capital accumulation and succession planning requirements in the light of upcoming changes to inheritance tax. This is definitely an area that we're seeing business owners starting to think about more concerned about is what am I going to do about my inheritance tax, much more so than they might have done pre-budget. Obviously, we understand this isn't necessarily the most exciting topic for people to think about succession planning, but it is nonetheless very important, and I hope we'll be able to show you why in a moment. So, pre-budget, shares in trading companies and groups largely qualified for 100% relief from inheritance tax, broadly speaking, with a few exceptions. So, in practice, it was less important when, or indeed if at all, senior shareholders passed on their shares. It wasn't so critical. Now, obviously, all of that's changed, or will be changing from April next year. And the effect is that the longer shareholders hold onto their shares and the more valuable they become, the bigger their exposure to inheritance tax. And if we're talking about companies that are growing, you've got kind of a double impact. The shares are worth more, and an inheritance tax event is potentially closer and more difficult to avoid. So, putting it very simply, the tax bill is both bigger and more likely the longer you wait. I think in the context of planning and preparing for a sale event, it becomes even more relevant because remembering that at the point of sale, all protection from inheritance tax falls away and you're left essentially fully exposed. You've got a pot of cash instead of shares, which is fully exposed to inheritance tax. So by implementing some effective planning now, it's possible to reduce your exposure ahead of that date rather than getting to that point and having a problem that you've got to deal with down the line when your exposure is greater and your options are potentially more limited. And there's a graph here which sort of illustrates the impact of giving away shares now at a lower value, but that with that sort of blue line and arrow, versus doing it further down the line on a sale event in, say, 5 years' time. The exposure's higher, and you've got to wait longer before it falls out of your estate. So why are we talking about this now in the context of the year end? Well, for those who feel that succession planning may be relevant, as I say, we've got that small window of time to sell some of your shares and get the benefit of the 10% BADR rate, which is an effective saving of about £40,000, up to £40,000 per shareholder, or 80,000 for a couple, if you like, compared to doing this after the 5th of April. I guess in practice, in a lot of cases, HMRC clearance is likely to be required. So we really are quite short of time to get that in, get that back, and get a transaction through. So just wanted to make sure that people are aware of that in enough time. I think what we're talking about is illustrated quite effectively in a recent client situation that we're helping with. Senior shareholder couple in their 60s who still own quite a significant shareholding. If we leave things as they are with their growth plans and sale objectives, they're looking at an inheritance tax liability on their shares of over £1.1 million. By buying them out now, however, it does two things. One, it releases capital that can be used as a retirement pot. And secondly, with appropriate structuring, it should reduce their inheritance tax exposure to zero. So what we did was just set out a few kind of numbers on this slide just to give you a flavour of the impact of this kind of action taken in time can actually have. So we've got the IHT saving of 1.1 million, capital gains saving for them before 6th of April 25 worked out about 56,000. There's also a stamp duty saving because of the way we structured it to prevent a stamp duty cost arising on the transaction. And by creating that pot of money, that retirement pot that can be drawn, we've saved over £600,000 of tax compared to taking it out as dividends. So that just gives you an idea of a bit of a flavour for the impact that planning carefully and in good time can have. I suppose our big takeaway message out of all of this is if you're a senior shareholder, let's say in your 50s or older, you should really be starting to think about capital accumulation now. How much do you need? How much do you need for your own personal needs? How much you're expecting to get on a sale event or some other kind of exit event, and what would you expect to do with that? And I think these are important questions to think through, because if you don't need it personally, but you want, let's say you want access to funds for loans or helping family out or donations or gifts, whatever it might be, or even just investing in other ventures, then I think now is the time to start thinking about succession planning. So I hope that is helpful in the context of the tax year end. Wanted to make sure everyone was aware of that kind of window of time we've got. And I'll hand you back to Jack to talk about the key takeaways.
Thanks, Gerry. So I think there's a few key things for every business owner to be considering as to whether they do. So firstly, order any double cab pickups by the 31st of March. Don't wait until the 5th of April and don't wait beyond that. If you're going to order them, get them done by the 31st of March. Make sure you've registered for the employment allowance. It's £10,000 a year that you can get. Make sure you've registered for that. If you have an existing house purchase going through, make sure you complete that by the 31st of March to save yourself the stamp duty. And get in touch now if you're currently looking to sell shares or release capital. It's important that you act on this urgently. As Gerry's mentioned, if we're to get clearance through HMRC and the solicitors, documents drafted, etc., you have to act now. It's urgent. And request a call back if you have any questions. Got our contact details on the slide now. Feel free to get in contact. We'd love to hear from you if you've got any questions. So just now move on to the Q&A section. We've had some good questions come through. Go on here, Gerry, perhaps you can say this. I can see I need to think about succession planning, but concerned about handing over too much control too soon. Should I still do this? It's fair to say this is a fairly typical concern from those that are, you say, in their mid-50s, or, but Gerry, you have comments on that?
Yeah, I mean, I think what we would say is that this is not necessarily about ceding control over the company. You might decide that's what you want to do as well as part of that, or you might want to change the balance of control. But you can do that. Passing on capital and passing on control are two separate decisions. You don't have to do the two at the same time or at the same rate. So you can retain control through a shareholders agreement, even as a minority shareholder, for example. And also, I think it's important to understand that we're not just talking about dishing out cash lump sums. These are shares. You can't go out and spend them. It's about passing down value so it doesn't accumulate needlessly in your estate, whilst retaining an appropriate level of control. I think probably one other thing that's worth mentioning in this context as well is that it's very important to make sure it's properly drafted by a corporate lawyer who knows what they're doing. And we can help with that with contacts and so on. But it's also important to make sure that as part of that structure, you retain control over future share transfers. So, for example, new shareholders can't just freely transfer their shares to somebody else without your consent.
Yeah, it's
Hope that
good.
helps.
Yeah, thank you. Had a couple around the double cab pickups. So, do the old rules for double cab pickups still apply to a second-hand purchase before April? Um, I that is buying a second-hand vehicle for April. So we're not aware of any specific guidance in it, but there's nothing to suggest in HMRC's guidance that the same rules won't apply equally to second-hand vehicles as well as new purchases prior to April. So it should be treated the same. It's also worth noting on this point that we expect that single cab pickups will continue to be treated as commercial vehicles for tax purposes, as they are primarily suited for carrying goods rather than people. And there's also a question around the VAT on double cab pickup purchases, and there is no change to that. So the current rules will apply. The only change here is in relation to benefit in kind and capital allowances.
So we've got a slightly quirky situation where the double cab pickups are treated one way for VAT as a commercial vehicle and as a car for benefit in kind. So
Exactly.
that's a bit strange, but that's the way the tax system works sometimes.
Yeah. We've got another question here. I like the idea of selling shares now and paying 10% tax, but my family can't afford to buy my shares. Does this mean I can't do it? Gerry, do you want to take that one?
So I think the answer to that is no, you still can do it. You still can do it. And the best way of doing it is normally by way of a company funded buyout. And what you're trying to do here is make sure that essentially the other shareholders don't have to dig into their pockets, but also that we can structure it as a staged payout over a number of years. And that comes down to that can be left totally flexible. So you can just leave it to take out as and when required, or you can come up with a staged payment plan that works around the company's cash flow forecasts. So you can, if you like, be bought out on paper now, but not actually take the money until everyone's ready. I think the key thing with that is around the structuring. You've got to make sure that the structuring is right and you get the right advice for that, and all tax aspects are considered. For example, as we've touched on already, stamp duty on shares, which can be a significant cost if it's not planned for, and also inheritance tax as well. At the point of a buyout, you can end up, if it's not planned for and thought about, you can end up actually increasing your exposure rather than reducing it. So that's an important one to bear in mind.
Yeah, it's good. I've got a question here then in relation to the inheritance tax side of things, touching on what you mentioned at the beginning, Gerry. So is a gift of shares to family subject to IHT or the 7-year gift rule? Don't know whether you want to take that one.
So I don't know if I'm understanding the question correctly. There's no immediate tax charge on a gift of shares to family, to individuals. However, it does remain in your estate for 7 years. Now, up till now, we've had or pre-budget, we've had the 100% relief. So you didn't have to worry about it too much, except in certain slightly more unusual situations. You didn't have to worry about the 7 years because it's all fully covered anyway. You got 100% relief. Now we've got to think about the 7 years because any gift could be at least partly exposed to inheritance tax for that full 7-year period. But that only applies, if someone gives away shares and then dies within that 7-year period. Hopefully that makes sense.
Yeah, it's good. That's clear. Good. I think it's been very useful. I hope everyone's found it useful. As I said, if you have any questions or would like to speak about your specific circumstances, get some advice on any succession planning that you might be considering, or if you're not sure whether it is for you, feel free to get in contact. Thank you very much.
Thank you.